Are you curious about what the financial landscape will look like in 2023? Wondering what trends and developments will shape the economy in the coming year? Join me on a journey through the exciting and ever-changing world of finance as we explore the possibilities and predictions of the year ahead. But before diving into more about that, let me first welcome you aboard for this episode of Finance Arc. On this channel, we set sail on a journey into the vast realm of financial matters, where we guide you through every step of the process and assist you in navigating the challenging world of finance, from simple budgeting advice to more advanced investing strategies. So grab your life vest and get aboard the Finance Arc. Let's start with one of the most critical factors that affect the economy: interest rates. Many financial experts predict that central banks will raise interest rates in 2023. This is because higher interest rates can help combat inflation and maintain a stable economy in the long term. Now, I know what you're thinking. How will this affect me? Well, raising interest rates can encourage people and businesses to save more money, which can lower inflation and support long-term economic stability. But it can also make borrowing more expensive, which might reduce the amount of money that consumers and businesses spend. When central banks increase interest rates, borrowing money becomes more expensive for both consumers and businesses. This means that people taking out loans or using credit cards will pay more in interest charges, while businesses will have to pay more for their loans. Consequently, higher interest rates can discourage borrowing and spending, negatively impacting economic growth. Less borrowing means less money to spend on goods and services, which can slow down economic activity, resulting in lower job growth, corporate profits, and stock prices. On the other hand, higher interest rates can also encourage saving. Higher interest rates make saving money more attractive to people, promoting them to save their money in accounts or investment vehicles rather than spending it. This helps combat inflation by limiting the amount of money in circulation relative to the available goods and services, maintaining long-term economic stability. While higher interest rates have a short-term negative impact on economic growth, they can promote long-term economic stability by encouraging saving and combating inflation. So do you think it's worth paying more in interest charges for the short-term benefit of borrowing money? Or should we focus on long-term stability and encourage saving instead? These are important questions to consider as we weigh the potential impacts of interest rate charges. Ultimately, it's up to central banks to carefully balance the needs of the economy and make decisions that support both short-term growth and long-term stability. Moving on to the stock market, it's a vital part of the economy and frequently provides insight into its state. The present climate of low interest rates is one justification for a positive outlook in 2023. The expanding economy also offers many opportunities for firms to grow and make money, which can likewise stimulate the expansion of the stock market. But don't let your guard down just yet. There are always risks and uncertainties associated with the stock market, and investors should always exercise caution when investing their money. One example is the COVID-19 pandemic. The COVID-19 pandemic caused a global economic downturn in 2020, resulting in a significant decline in the stock market. However, massive stimulus packages and low interest rates led to an economic recovery in 2021, leading to a resurgence in the stock market, particularly in sectors hit hard during the pandemic, such as travel and hospitality. This recovery highlights the interconnection between the economy and the stock market, emphasizing the importance of a healthy economy for the growth and performance of the stock market. Now, let's talk about something that's been making headlines for a few years now: cryptocurrencies. According to many financial experts, cryptocurrencies will gain even more traction in 2023. One reason for this is the increasing number of use cases for cryptocurrencies, from making payments to investing in stocks and other assets. One instance is El Salvador's adoption of Bitcoin as legal tender, which is a prime example of the growing acceptance of cryptocurrencies, with other countries as major corporations in the following suit. The adoption of Bitcoin in El Salvador has sparked a wave of interest in cryptocurrencies, with other countries such as Paraguay and Panama considering similar moves. Furthermore, companies such as Tesla and PayPal have also embraced cryptocurrencies, with Tesla investing $1.5 billion in Bitcoin and PayPal allowing users to buy, sell, and hold cryptocurrencies on its platform. However, the volatility and lack of regulation in the cryptocurrency market remain significant risks. For example, the value of Bitcoin crashed in 2021, losing almost half of its value in a matter of weeks, which highlights the unpredictability of the market. Nonetheless, the increasing adoption and use cases of cryptocurrencies suggest they are here to stay, and their impact on the financial industry could be significant in 2023, especially in areas where they provide a useful and secure substitute. Finally, let's talk about green investments. With the local movement towards sustainable lifestyles and the fight against climate change, investors are anticipated to continue gravitating towards assets that are environmentally friendly and sustainable in 2023. This includes renewable energy sources such as solar, wind, and hydroelectric power, as well as electric vehicles. Another instance of the growing demand for green investments can be seen in the surge of investment in renewable energy projects in Asia. According to a report by the International Energy Agency, Asia is set to become the world's largest market for renewable energy, driven by increasing government support and declining costs of renewable technologies. In China, the world's largest emitter of greenhouse gases, the government has set ambitious targets to achieve carbon neutrality by 2060, which has spurred massive investment in renewable energy. In 2020, China invested $83.4 billion in renewable energy projects, more than any other country. Similarly, India has set a target of achieving 450 GW of renewable energy capacity by 2030, and has already achieved 100 GW, with plans to add another 175 GW by 2023. This has opened up opportunities for investors in green energy projects, including solar and wind power. The trend towards green investment is expected to continue in 2023 as more countries and companies commit to reducing their carbon footprint and transitioning to a more sustainable future. This represents a significant opportunity for investors to participate in the growing market for green energy and sustainable investments. As we look towards the future of the global economy in 2023, it's important to approach it with a positive mindset and a willingness to adapt to potential changes. By staying informed and working with financial experts, we can navigate these uncertainties and capitalize on the opportunities for growth and recovery. So, let's stay curious and excited about the potential of the financial world in 2023 and beyond. Remember, the future is what we make of it, and with the right mindset and strategies, we can achieve our financial goals and create a brighter future for ourselves and for the world. Are you ready to take control of your finances? Subscribe to our channel for more tips on savings and investments. Don't forget to turn on notifications so you never miss a new video. Let's grow our wealth together. Stay tuned.